afternoon, everybody. We're excited for this final panel and to be the barrier between the panelists and happy hour. So we will be efficient with our time and hope to make this as interactive as possible. Happy to be moderating. Paul Barrett, Managing Director with BelHealth Investment Partners. We're a healthcare-only private equity firm headquartered here in New York City, 10 people on our team, $500 million under management. We try to differentiate ourselves in three ways. One, that we're focused exclusively on the healthcare sector. Our entire team has dedicated their lives, professionally and personally, to supporting healthcare entrepreneurs and founder-owned companies. Two, we have a partnership model, so we exclusively partner with founders and entrepreneurs, always the first institutional capital. And lastly, we're at the lower end of the market, so 1 to 8 million of EBITDA. Most relevant for the conference today, oversee Noviderm Partners, which is our dermatology business, New York, New Jersey, which we're very excited about. We put it together in June, July of 2018 through 4 independent practices. We built a corporate office here in New York City and just completed our 5th acquisition. So now we're 45 doctors, 60 million revenue, and off to the races. Very excited to introduce fellow panelists, Matt and Phil. Matt, if you wouldn't mind just kicking it off and
Sure.
giving an intro.
Matt Jameson, I'm a managing director at BlueMountain Capital Management. BlueMountain's a roughly $20 billion alternative asset manager. We invest in all across healthcare providers and services, deployed a little over $1 billion over the last 3 years. Within physician practices, we've spent a lot of time with a rapidly growing anesthesia platform company. We spent a lot of time in women's health, primary care, gastroenterology, urology, and orthopedics.
Hey everybody, Phil Zaorski at Frazier Healthcare, based in Seattle. We're a healthcare-only firm. We've been around since 1991, so we've been at it for 28 years. And we have 2 strategies at Frazier. We have a life science strategy down in the Bay Area, down outside of SF, doing pre-commercial stage investing in pharmaceutical assets, drug development. And then where I'm located, which is in Seattle, which is our headquarters, doing growth buyout and investing. And so we're looking to take positions in profitable healthcare service businesses, everything from payers to providers to distribution to med products. And we're looking to take control positions in our investments. And on the provider side, we've had fairly good exposure and success in orthopedics, dermatology, GI, and vein clinics business as well.
Thank you, guys. So we have 3 main topics that we're going to hit. The first is negative PR associated with non-MD ownership and specifically PE ownership. The second is MD and provider retention. And the last one is structuring for an exit and the exit environment broadly for MSOs. And then we'd love to make this more interactive and hit the Q&A. So the first topic, the negative PR that a lot of us are fighting through and experiencing. Phil, if you wouldn't mind kicking this off. I think the way that we like to tackle this is if you could walk through your pitch, specifically when you're meeting with MDs and founders and how you're kind of navigating that landscape.
Yeah, for sure. So for us, similar to Belle Health, I think the advantage that we have at Frazier is that healthcare is all we do. We've been doing it for 28 years. And so I think that is an advantage to others who have more, who are more generalists or have different verticals. And so we go in and we have a deep appreciation for the provider community specifically and what they do. Frazier, just as a little bit of background, was started by an operator 28 years ago on the biotech side who said, well, I'm giving advice for free to those out there in the provider, the payer, and the biopharmaceutical industry. Well, why don't I invest part of my own money, but also get investors to back me? And so we have a great appreciation for the operator side of the equation. And so when it comes to provider groups, what we like to pitch to provider groups who've been successful at is, and I think the gentleman from Revelstoke made the same comment, which is, we'll take care of the financial side of the equation, especially here with provider groups taking care of the back office, if you will, also in terms of growing, so M&A, et cetera. And you stay at the forefront of the clinical side of the equation. So for all of our provider groups that we've acquired and partnered with the physicians with, we've always established a medical executive committee at all of our provider groups, and we've put that at the forefront. So what's good for the patient is good for the business ultimately. And so for us, we keep clinical at the forefront, establishing a medical executive committee where all clinical decisions reside. At each of our board meetings, we devote a section of those board meetings to just clinical. We oftentimes, if they don't exist, we're establishing audit committees, and we're looking at things like chart reviews and upcoding and downcoding. And so we keep clinical at the forefront and let the operators operate. And then we'll take care of the capital that's required to invest back into the business in terms of infrastructure, but then also helping the team think of ways to grow both on a de novo basis or on an M&A basis.
Great. One follow-up question, Phil, and something that we are constantly having discussions about. How do you approach the associate doctors, the non-owners? And a common question is, okay, new ownership coming in, have been working at this practice for 10 to 15 years. What's your time horizon? How fast is this turnover going to be? How do you kind of manage those discussions?
Yeah, generally the provider groups that we're investing in are already platforms, meaning they already have a certain level of sophistication. So we're walking into investments where there are already generally well-defined plans in terms of associates going to partnership. So I would say in my experience, we have not had to set up the path right from associate to partner. But what we do say is for associates who say, well, what happens to me now with you guys in the majority position as an investor? What we say and what we do for the associates is say, look, you will continue to be on the partnership path that you've had. We're again not getting into, we don't like to get in between the managing physicians, if you will, and the associates, that discussion. So they'll continue on their path. But what's nice is with institutional capital now behind that provider group, as the business grows, both de novo as well as M&A, the economic upside for an associate could actually be more beneficial to them than as if it was a standalone practice that continued to be owned by the original founding physicians. And so a lot of times they're able to invest into a business, and we allow our associate physicians to invest in our businesses at fair market value. They're allowed to participate in an entity that is continuing to grow and has the support of institutional capital. So we look at it we position it and tell our associate physicians that you'll be able to participate in an entity that will see kind of accelerated growth that may otherwise not be there if you didn't have a partner along the way to support the various growth initiatives.
Matt, first initial question, how are you overcoming the negative PR associated with PE investments when you're pitching founders and physicians?
Yeah, it's pretty easy, right? Payers have consolidated. Large hospital systems have consolidated. Individual provider practices have largely not consolidated. So they are getting the short end of the stick as they go to negotiate payer rates, as they go to interact with hospital systems. And the way you fix that issue is scale, right? It's underlying the last presentation on going and renegotiating rates. You go and renegotiate rates when you bring more scale and more quality and more sophistication to the table. So at the end of the day, practices need to understand that there is going to be a push for that scale and that you're going to be at a disadvantage. So there's multiple ways you can get the scale, right? You can go sell yourself to be an employed physician at a hospital group and in a hospital system. And some of them are very generous and very good employers, and some of them aren't. It's a completely mixed bag. And we've seen a lot of physician groups come out of hospital systems unhappy with what they've sold into. And so then there's private equities, another option within that table. It's just there has to be good alignment, and what you're talking about is absolutely correct. If there's not physician alignment, that's a table stake for what needs to happen. We as a firm tend to look at how much we buy down, the scrape or cap rate, and say, we don't want to be buying down a lot. We want to see a lower buy down. We want to see greater rollover equity of the physicians to enhance alignment. At the same time, and I agree with what the gentleman from Revelstoke said, we're not going to get involved in clinical operations, but the reality of it is there's a Venn diagram. In clinical and business, there's overlapping pieces. They touch each other. And you have to be very conscientious that you're entering a marriage when you sell into PE. When we partner with you, it's a marriage, right? We have to believe it and you have to believe it, because it's not going to be something where, hey, we're just, clinical is completely not touched, because business operations and clinical naturally overlap. It's not that we want to be clinicians, we can't be clinicians, we're investors and finance guys, but at the end of the day, operations will impact clinical.
I guess a follow-up question on that. What are some, whether structural or other techniques or strategies that you're able to bridge that gap between the executive or the finance team and the management team and the clinicians?
Yeah, I mean, we want to see financial alignment. We want to see cultural alignment. We're very big on structures and making sure that, whatever structure we put in place doesn't create a disincentive to work. We've seen, a number of transactions that have been marketed, some of them have gone through, where physicians are selling down a tremendous amount of income. And what we've seen from that is there's just a natural tendency in human nature to work less if you're going to earn less. And there's going to be a natural tendency, if you have had a big payday, to maybe take 3 or 6 months and take that dream vacation you wanted, right? In a private equity setting, that doesn't work, and that creates disalignment with the physicians. And we need to be the folks who are thinking through, why is that the case, and is that something that's smart to do, even if it's over the short term.
So moving on to the second topic, MD provider retention. It's obviously incredibly important. The physicians are the business with all MSOs. I guess, Phil, I'll start with you. What are some of the specific strategies that you're deploying to best ensure MD and provider retention?
Yeah, sure. So what we're doing at a bunch of our provider groups is building out the ecosystem, I'll call it for lack of a better word, in terms of their way to make an earning. And a lot of times when we get into our provider groups, they have their fee-for-service traditional income as we all know it. And then as we build out the practice, and for example, GI or orthopedics is another good example, when you continue to build out the practice from just the traditional fee-for-service income in the clinic to then building out, for example, ambulatory surgery centers. At our orthopedic business, we also took risk, and so we had a quality incentive bonus program that we had in place, and that we shared back with the doctors. And so, from a retention standpoint, and also there was talk about income repair in prior discussions. This is a way where the docs post acquisition don't feel like they're in the hole, and that there's a way to get the income repaired for those physicians, and not only that, but get them above where they were. And so over our hold periods, we're looking to build out those other fee streams in addition to fee-for-service. So other facility settings, and then quality as we get into more value-based care. And then I think the last piece is equity, of course, right? And so a lot of times you start with that. A lot of the physicians are rolling over equity in a meaningful way into their practices. But then also thinking about incentive plans, so whether that be stock options or incentive units, depending on the legal structure. But we're thinking about ways to incentivize people with equity to, again, maximize alignment over our whole period.
And Matt, same question. What are you guys doing to ensure, as best as possible, MD and provider retention?
Yeah, I mean, I think, what you said is absolutely correct. I mean, I think you can add to that, you can create deferred payments on the cash you buy down to create, a piece of bridging mechanism to income repair over time. I think that there's a lot that has to be done in terms of getting quick wins, showing that, the MSO that you're creating adds value to a physician's life. I think over the medium to long term, it's starting to think through succession planning. Practices have a mix of age. There will be folks who don't raise their hand in the initial deal, but 2, 3, 4 years later are looking at potentially retiring. If you can create a planned soft landing and a recruiting function that's constantly in the market, constantly finding good candidates and creating a transition period, things like that, you can create a much more stable practice. And if you really get something that's institutional, right, it doesn't become dependent on any one doctor or any one provider. It becomes something where the organization lives on. And I think your orthopedics platform did a really good job of that.
Yeah, I think just to put a finer point on that, I think early on when they're early investing into the PPM space, people have focused, or not focused, but initially it was let's monetize that profit stream at at a physician group by the founding physicians or basically any of the partner physicians taking obviously a reduction in income, monetizing that profit, getting paid an upfront multiple for that, and then obviously having a lower income stream thereafter. I think that's a poor model and it's not sustainable. And so for any of our physician groups that we've acquired, we've always looked at it and said, with this specialty, what could we do with our capital, because that's what we're bringing, what could we do with our capital and our people, our expertise, and our network to then kind of repair not only the fee-for-service income, but then build out those other income streams, because I think that is long-term sustainable. And I think the early day PPMs of let's just monetize the profit that was in the physician group, I think that's not a sustainable model.
And the other side of retention is recruitment in terms of driving growth. I could start with you, Phil. If you could speak to specific recruitment strategies at maybe ortho or GI or one of the platforms, anything unique that you guys are doing to drive recruitment?
Yeah, I think, for example, at our orthopedic group, and again, there's presentations earlier about investing in platforms with the thought leaders, with well-respected, well-regarded physicians. At the end of the day, people aren't joining physician groups because it's Frazier backing them or BlueMountain or it's BelHealth, and they're really, if you're a physician coming out of residency or your fellowship, you're saying, what is the group look like, and who are part of those, from a provider standpoint, part of those entities where I want to develop my career after getting out of residency or fellowship. And so, for example, in our orthopedic group, we're the largest, or one of the top two groups, I would say, in the Phoenix market, and then we grew into Flagstaff and then south to Tucson. And so we have the market density as well as reputation to recruit docs into that platform. So for us, it's really looking for the clinical leadership on the front end when we're diligencing where we want to invest our capital, because I think the best way to recruit physicians is with other physicians.
Absolutely.
Yeah, I think that, if you have an MSO at scale, right, at the end of the day, you need to be distinctive at recruiting. And it's not only physicians, but it's also advanced practitioners, it's other providers within the practices. And you need to view recruiting as a process. It needs to be standardized. I agree with what you're saying, that you need physicians recruiting physicians, you need nurse practitioners recruiting nurse practitioners, CRNAs recruiting CRNAs. I think that makes a lot of sense, but I also think you have to manage it like a process. You have to look at metrics. You have to actually know what you're looking at. What's the average in the country around the time to recruit that physician or that position? What are you doing it at? Why are you doing it at that? What's your retention rate? What's your 6-month turnover, your 1-year turnover, et cetera? All of those things are important, and I think that a lot of practices just don't look at it that way. They're in the business of practicing medicine. Someone retires and they say, I need to go recruit. Let me go talk to my network of friends, colleagues, et cetera. I think that there's value with groups that have people in academic settings that are overseeing fellowship-trained physicians, because they know who's coming out and who's going to be the most entrepreneurial and who's going to be the best fit in a practice. There's being a constant presence at nursing schools, being there every year to recruit in the same quantum or numbers, and not just coming in once every 5 years because you have a need. And that consistency, I think, helps a lot.
Yeah. For us at Novoderm, it's exactly that. We have a fellowship program on the cosmetic side for dermatology, and also a laser program, which is a specific pipeline and funnel for us. And then it's the affiliations with all the major hospitals and health systems and residency programs in the greater New York City area. And that clinical leadership will, it totally fuels the funnel. So moving on to the third topic, structuring for an exit and the exit environment broadly for MSOs. So when building a platform and approaching exit, what are the top 2 or 3 priorities to get right in your guys' mind with an MSO prior to entering the sale process? Matt, if you want to.
Sure. Yeah, I think it's like any other business. Strategy is probably number one, and having the right growth strategy and the right go-forward strategy. I think there's also a piece of it that's a communication strategy. At the end of the day, you can't really sell an MSO without the doctors being on board, and there needs to be physician alignment. And the best way to create that alignment is to communicate regularly on what you're looking at, what you're evaluating, have the right set of physician leaders who are guiding the conversation. And I think just, the rest of it is really just making sure that your house is in order in terms of, the infrastructure you've built out, and that it's, ready to go through a sale process. But that's generally any business, I think.
Yeah, I would echo your comments on the growth side of it. And I would what we like to say is a provable growth strategy when you're exiting a business. And so you could put anything on a page when you're trying to sell a business, but it's really what have you proven over your investment period. And so early, kind of day one, post-close, you have to be very cognizant of monitoring performance around your stated growth initiatives. And so whether that is, it's a clinic-based business, opening up de novos, tracking the performance of de novos and how the pace and tracking pace of de novos. If it's M&A, how well are you acquiring the businesses, at what multiples, but then also how are they performing post-close? Were they successful integrations or were they poor integrations? And are you ahead from a profit standpoint or behind on a profit standpoint? And then on the base business, also thinking about your existing group of physicians in terms of things like which physicians are new and ramping, and how have they ramped over your tenure? Mature physicians, what is their organic growth? And then also things like just the average age of your physician group as you look to sell, and in terms of alignment, who's long for the world and wants to stay, and which doctors are right on the cusp of retirement and looking to exit on that transaction. I think you have to be very clear with your physician group. Again, going back to day one, around expectations, around what is the time horizon, who's going to be here and who's not. But when we look to sell our orthopedic practice, for example, recently, it is being able to show the playbook and be able to prove the playbook based on historical experience. And that usually will garner you, obviously, better valuations on exit.
And with your ortho group, did you guys achieve full systems, practice management, consolidation, and org chart consolidation prior to exit? And how important was that for you guys?
We did. The nice thing for us is our orthopedic group already they didn't have the MSO, but they already were run effectively like a corporation would be. It was run by physicians and still is run by physicians, but it was already run very much like a business, almost like an MSO without having the MSO. And so that housekeeping was kind of already taken care of.
Man, I think that it comes back down to being like an institutionalized entity, rather than being an acquisition of a certain set of physicians. If you can take it from something like that to the point where, a loss of any single physician for any reason doesn't impact the business. You look at an 8-physician orthopedic practice, the loss of usually the spine person or one of the physicians there dramatically changes the economics of that practice. The loss of one physician for just to make the example for your orthopedic business is largely irrelevant one way or the other because it's fully institutionalized.
Yep. And I think just to add to around, I think a point around standardization, which is important. I think we're big believers in healthcare generally, on the healthcare services side, of standardizing processes and procedures and making sure you're on one system. So depending on what provider group you're looking at within the Frazier portfolio, although we may maintain local brands, for example, in the local geographies, from a back office infrastructure perspective, we are consolidated. And I think with healthcare service, and especially tackling issues with the payers who are much bigger than us, being able to say your physician group is standardized, it makes it that much easier to look at both your clinical metrics and operational metrics, and so that you can have those battles if you need to with payers around providing care. What we found is if you're on disparate systems, it's hard to make sense of that data quickly so that you can react to, for example, those discussions you're having with payers. And so everything for our provider groups is, if it's not at day one, over our investment, we're standardizing on single systems and obviously processes and procedures.
It also touches on scalability. right? You're going to get a higher multiple on exit if you're a scalable platform, right? Just because there's going to be more growth with it. If there's a lot of, I'll call it rolling up the sleeves for the next buyer to fix systems to get things onto one IT system or one platform, you're going to sell at a discount. It's just going to be the natural way of things.
And how do you guys feel or think about branding, multi-brand versus one brand as you're approaching exit? Is it case by case, or do you have a uniform philosophy as it relates to that?
Yeah, I'll just go first. For us, it actually depends more on the, not so much on exit. I think exit will take care of itself. For us, it's more around the referral patterns for that specialty or for that business. So for example, our vein clinics business, which is doing all medically necessary vein ablations for venous insufficiency, we are about 60-40 split in terms of 60% direct to consumer and 40% largely getting referrals from the primary care docs. And so in that business, though, because it's more direct to consumer, there's one brand nationwide, and that you get some value out of obviously having one name in the market when you're marketing to consumers and patients. On the flip side, though, for dermatology, for example, or our GI business, we've kept the local brand. So although we're consolidated in the back office from an MSO perspective, we've kept the local brands, which, by the way, have been there far longer than Frazier, would ever be. And so we very much respect the brands in the markets they're in.
Yeah, we tend to not do a lot of retail healthcare in our group. So from the PPM side, we tend to keep the existing brands because, to your point, they have real brand equity, and part of what we're investing in is the long-term history of the practice being good clinicians.
So final question, then we'd love to open up for Q&A. Future predictions around consolidation, any 2-3 sectors that you guys are laser focused on to entering? That's, I guess, the first part. And the second part, do you think the breakneck pace of MSO consolidation continues as it has for the last handful of years?
Do you want to go? What are my views on predictions? It's being recorded. So what I would say is I think areas that are interesting and partly biased because we're in them, or were in them recently, but I think orthopedics and GI are pretty interesting. I think those are still early innings, very fragmented markets. And not only from the macro fundamentals, but also there's, again, from building an enterprise, you're not simply relying on a fee-for-service business in an environment where utilization is going down, where there's a keen focus on utilization. And again, similar to Revelstoke, we're not in the game of taking a doc and trying to increase his utilization. So I think GI and orthopedics are interesting because there's a lot you can do within those environments. In addition to just the fee-for-service income, you have different facility settings. In orthopedics, for example, we took a risk on musculoskeletal, certain DRGs within the hospital. And so there's more you can do to build out this enterprise, if you will, for lack of a better term, that make those interesting. In terms of predictions, I do think that we'll see in the next 3 to 5 years, I think you'll see winners and losers from a private equity perspective. I don't think it's been up and to the right. I think there's a lot of capital chasing fewer and fewer quality assets, and so I think looking back on it, what we'll see is that, and this is not novel, but I think you'll see the early movers in these specialties have made good returns, not only for the private equity firm, but for the partnering physicians. I think when you get into later in the game, I think you'll see a little bit of dilution in those kind of returns that you would have seen for the early movers, because there's a lot of it's a lot of money going to different specialties, and I think the quality of the platforms out there that really should be taking institutional capital are becoming fewer and farther between.
I would agree with you on the specialties that are interesting. I'd probably add, primary care and women's health have been pretty hot sectors as well. I think in terms of predictions, I agree with you. I think it'll get a lot choppier. I think some of the structures that have been put in place have been aggressive. I think some of the debt structures that have been put in place in some of these these specialty deals have been extremely aggressive. And I think that there's just going to have to be more restructuring around figuring out how a business that has a high amount of physician rollover equity and needs that alignment delevers a balance sheet that maybe was made in a land grab type of mentality and just hasn't come to fruition. I think we'll see a lot more of that as folks have been really, really aggressive over the last 3 years, especially in spaces like I'm sure you see it in derm.
And I think you'll see consolidation for sure. Again, if you look at any of these specialties, even going back to dental, which is kind of the first PPM kind of roll-up play, if you will, from a private equity standpoint, you will see more consolidation, which goes back to your first comment, which is you saw the consolidation with payers over the last 2-3 decades. And I think you'll see that on the PPM side, and also you'll see that as I think a mechanism for folks, both physicians and their private equity partners, to realize synergies and to get more scale. So I think consolidation will be coming.
Great. Love to open it up for some questions. Yes.
So as you take a look at as you take a look at your investment targets, do you look at the probability for success in clinical practice, operations transformation, or do anything to take a look at the probability or the propensity for change in the owners of the practice? So we haven't heard a lot about ops transformation. We've heard about some, pretty traditional things, growing the business, capitalizing ASCs, et cetera, et cetera. What is your perspective on ops transformation as you look at targets to invest and the ability of the owners to change?
Yeah, so, we generally don't underwrite physicians changing how they generally behave, but what we can underwrite is investing in a practice that has invested in itself in standardized processes, in doing things the right way, and making that scalable, right? So we believe that if you have a strong physicians that are a set of physician partners, and you do bolt-ons, that doctors can influence other doctors. It's more difficult. It's not as straightforward as saying, there's 5 too many heads in RCM. You cut those 5 heads and you have a synergy. I think it's a lot. There's a much bigger discount, at least in the underwriting, in my mind, on that.
Yeah, I mean, for Frazier specifically, in our strategy's name, it's growth buyout, and for us, the growth is important. It's an important aspect of it, of course, but as it relates to ops, what we will do is make investment in ops that enable that growth. And so, for example, we've put capital and invested money to improve ERP systems, accounting systems. We've on the clinical side, we've instituted programs around chart reviews and putting in technology to look at things again like upcoding and downcoding again, because those are the although not front and center from a growth perspective, those are investments that will either enable that growth or maintain the integrity of that practice. So when you look to sell that business, then the next individual, the next investor that looks at it will say, okay, you've appropriately invested into your infrastructure, and you don't have that call it quote unquote debt that the next guy will have to invest in. So that's how we generally look at it.
I think it's a version of economies of scale too. It's one of the scale things that we haven't talked about, right? Is IT and systems, right? In order to have a practice that can implement what you're talking about, you need scale. You need to come together, and it's part of tying this back to the first point. It's part of the pitch of what you're going to say to a doctor. Just it's look, you have different incentive systems that are coming down. You have different investments in IT that you need to make. Can you make those as a standalone practice? Does it make sense to? Does it make sense to make them as a whole, where you have much more scale, can implement all of these programs? It's a much stronger pitch.
And then I think, for example, what investments increase efficiencies, and so we're evaluating at one of our provider groups putting in a new PAC system. And that's going to be probably $1 million investment, but at the end of the day, it will lead to better efficiencies in the clinic and save time when you think about uploading images and downloading images and sending them back and forth between corporate and the clinic. And so I think operational efficiencies are things that we'll also look to invest in because they make sense as you try to scale the business.
Yeah, and at Noviderm, we're incredibly focused on operations. I mean, we put together small individual practices, anywhere from 2 doctors to 15 doctors, and it's systems, it's equipment, it's technology, but it's also resources. First director of HR, or first in-house financial resources. So these are small groups that we're attempting to, in every way, purchasing, improve the experience of the staff, but also look for opportunities from a financial perspective, whether it's buying better or cheaper or faster. That we can improve the individual clinics in every single way. So.
Thank you. What kind of returns or IRRs have you used when you underwrote the acquisitions or investments that you've made? And then to the extent that you've had any monetizations or realizations, what kind of IRRs have you received? Or maybe if you haven't, what kind of IRRs would you be using today to make additional investments, given that it's gotten, as you said, there's more money chasing fewer quality assets?
Yeah, I'll talk more just at a high level, just generically, because I think Frazier, from a private equity standpoint, probably similar to a lot of industry, or a lot of my industry brethren. So we're looking at generally 25% IRRs over kind of a five-year hold. We've had great investors that we've held for 3 years and great investors that we've held for 7 years. So we're not necessarily married to the 5 years, but we usually use that as a gauge when we talk to those who are buying assets from. And again, like I said, a hurdle rate of about a 25% IRR. Now, that's for lower middle market, and that's for Frazier specifically. I would say as you move up market, obviously those hurdle rates will come down as you're deploying larger amounts of capital. But again, I think it's a little bit firm specific. But again, you'll find the goals at Frazier similar to others, as we all have common LPs that are looking to put dollars to work in the healthcare space.
Yeah, I think ours vary anywhere from 15 to 30%. It really comes down to on the lower side of that, where are we in the capital stack? So we'll do structured equity as well as just pure common. We'll do structure with control. So how that waterfall gets cut, I think, influences your risk reward. But I would say on a straight buyout, 25% seems like a reasonable number.
Yeah, we're always trying to drive towards a 3 times gross cash on cash return. That's what we're really focused on. And obviously it's a more competitive environment, particularly at MSOs, but we attempt, since we're at the lower end of the market, to always buy for 5 to 7.5 times from a multiple perspective.
You talk about the importance of physician recruitment. How do you guys treat all of those recruiting expenses up to include headhunter fees? Is that run through as a shared operating expense under the MSO, or is that pushed solely on the physician group side of things?
Historically, we've had it at the MSO, you have some headhunter fees, but most of that you try to drive in-house to be a more distinctive function and to own more of that. So we view that as a part of the MSO and as part of the, you call it practice management fee or whatever you want to call it, that's charged to the individual practices.
Yeah, we do it the same way.
Yeah, same for us. It's an HR function that's at the MSO level. Any other questions?
Sort of a two-part purchase.
Wait for the mic.
Thank you. So when you describe the income repair for the physician, can you describe specifically what you do in that regard? I mean, do you take the total revenue and you take the shared savings and you say you're going to get X percentage of that? And then the second is, if part of the purchase is stock for the physicians, if there is a sale, are they able to cash that out entirely upon the sale?
Guys?
So I take a stab. Sure. On the income repair, I guess I'll give you a little bit more color because every specialty is different, and every the ability to do more, I guess, would be different too from a specialty perspective. But when I, for example, talked about orthopedics or GI for that matter, and you could apply it to other specialties. Generally, we're getting into situations where we can invest our capital into growing out the services and the settings in which care can be provided. And so what that means is usually when we initially get in order for the partner physicians to monetize their asset, they will take a hit to their income kind of day one in order to create that profitability within the entity. But then we're only investing in physician groups where we can then make sense of it in terms of, okay, if we expanded into, for example, ASCs, which I've mentioned before, we will allow physicians to invest in those entities and thereby take a piece of the distributions from, for example, the facility fees. In addition to bringing surgery cases over to the ASCs as well, which is on the fee for service side. And then again, depending on the specialty, we took risk at our orthopedic business, so we actually had a quality incentive bonuses where where physicians hit certain benchmarks around cost, obviously, and savings were created, a piece of that would be distributed back to the physicians. And so what we thought about when we thought about income repair was, what are the other fee streams that you could establish post-close, and maybe not immediately post-close, but in years 2, 3, 4, and 5, where a physician could see themselves getting back to or better than what they were making before, whether that's through fee-for-service, whether it's different facility settings, whether it's value-based care programs or other initiatives that you're taking in that you're taking into account. And so that's how we thought about repairing a physician's income stream post-close.
No, I agree with all of that. I think it comes down also to how much you're buying down and what your plan is going forward. Most of the deals that we do, there's a very clear set of plans, and here are the actions. Here are how we think it bridges out, and we can communicate that to the physicians and say, here's where we think you'll be after year 4 or year 5. And we think we'll get you back to 93%, 103%, whatever the number is. The splits can be, how much based on how much you buy down. You can separately split out different pieces of it. You could, separately bifurcate, the rate increase component and say, you get more or less of that component versus organic growth. I mean, I think a lot of times we try to structure to incentivize organic growth in the practices, because we feel like that's something that the physicians can really influence, whereas maybe the MSO has a little bit more ability, given the scale, to influence rate negotiations.
Yeah, and then just to go back to other opportunities we look at in specialties, certain specialties, again, will be different, but looking at ancillary income as well, what we call ancillary income, which would be things like adding physical therapy if it's orthopedics, or path lab or anesthesiology if it's in GI. And so you're doing more, you're becoming more of a one-stop shop, and the physicians, both partner and then ultimately associates, as they transition from associates to partners, should be able to participate in those other income streams as the practice grows and as you develop into those other areas.
And quickly on the stock question as well, we thought it was really important that everyone had stock in the same, holdco, and that is cashed out at exit. We have our preferred equity, and we structured in a way that's A-class units, the preferred. All of the 5 or 6 original founders rolled into B-class units, common equity. C-class is the executive team, and then D is all full-time associate doctors. We offer an equity award. They have to put up a nominal amount to get that, but that was part of our pitch to all the original medical directors, that we want all full-time doctors to potentially be owners in the same box that we are, so that we can all be rooting for all the individual practices and doctors and have the the financial upside at exit together.
I think the one thing to add too, in terms of the equity, is a physician, unless they're retiring, I would say, should expect to roll over equity into the next, the next investment, whoever the next buyer is. I think, and that percentage of how much of my proceeds am I required to or expected to roll varies. I mean, we've seen anything from 50% for kind of the partner physicians who are senior in the organization, to things like 20% for up and coming physicians. But I think, and you should expect that upon a liquidation event, sale, that physicians should be thinking about rolling into the next, rolling a piece of their proceeds into the next, the next 5 years, the next investment cycle, if you will.
We have one more question.
One more?
What percentage of MSO investments don't go well? What are the earliest symptoms and remedies? What did you learn from the mistakes, if it ever happened? And just share your experience with the worst situations.
I kind of think it's like an original sin problem, in the sense that Most of the reasons why I've seen that MSOs don't go well is that they're bought at multiples that are not sustainable with structures that aren't sustainable, and those catch up over time. Compound that with maybe some operational hiccups, the inability to properly integrate acquired practices that may have been acquired at heavy multiples, and you have a recipe for just an over-levered entity that'll struggle with that debt load.
And yeah, I think quality of the physicians and the individual practices themselves. If you're buying 100% of a retiring physician practice, on the risk continuum, that's as risky as it gets. You're basically buying a business that's walking away. And if you think that you could rebuild the practice or bring in associate doctors. So I think that, and obviously shifting to the other side of things that would be more successful in what we've seen is more entrepreneurial physicians that are looking for a sense of partnership, that are looking to roll equity, that are vested, that are staying medical directors. Those are the only ones that we're investing in that will remain carrying that flag, because we're not physicians. And we don't like the risk profile of a business that we're really investing in it and they're potentially walking away.
I think, and the last thing I would add is transparency and being on the same page as your partners, in this case the physicians, is key. And so for our physician groups, making sure that the physicians have transparency into the financial performance of the business is critical. And then also day one, having the same expectations around, for example, investment horizon. We're targeting 5 years, but are your physician group partners thinking this is going to be a 10-year marriage? And so I think it's the expectations up front about just the basic kind of blocking and tackling of the partnership, but then making sure that throughout the investment there's clear transparency in terms of financial performance and decisions that are happening at the MSO level and why they're happening. So whether that be at the board meeting, we obviously have physicians on the boards with us, whether you're hosting town halls or quarterly meetings or monthly performance calls with your physician group. Again, in our physician groups, we have medical executive committees, which are usually the senior docs and usually regional, so communicating back to the leadership within the medical executive committees, who then take it back into the field, so to speak. I think both transparency and setting expectations are really key to having a successful marriage, as we said.
Great. Thank you, everyone. Appreciate it.